Good morning, and welcome to today's webcast, State and Local Tax Considerations for AI Companies. Before we get started, I wanted to share our big news that Moss Adams and Baker Tilly have joined forces to redefine accounting, tax, and advisory services for the middle market. It's really exciting, and you can read more about it on our website via the link in the slide deck and handouts widget. I am now going to play a brief housekeeping video.
Welcome and thanks for joining us. Our webcasts are designed to help elevate your business performance. Transform your future for the better with advisory solutions tailored to your vision and supported by our collective technical resources. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget. You can ask our presenter questions during the webcast by typing a question in the Q&A window and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% or 3 of the 4 polling questions, which we'll ask throughout today's presentation. Polling questions will appear within the slide window. To participate in the polls, please click on your answer and be sure to hit the Submit button to record your response. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry, if you can't download your CPE certificate today, we'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our group CPE attendance sheet to receive credit. The attendance sheet is available in our slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit only can be awarded to participants registered as themselves, and isn't available for participants who view the on-demand version. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
Today's webcast will be presented by Glenn Walsh, principal in Orange County. Glenn has practiced public accounting since 1993. His expertise includes state and local tax compliance, multi-state tax reviews, and due diligence. Evan Krueger, senior manager located in the Seattle area. Evan consults with clients on an array of state and local tax issues, including sales tax, gross receipts tax, other indirect taxes, and state and income franchise tax. And Matt Graham, state and local tax and service and use tax senior manager located in Seattle. Matt has provided consulting services since 2014. He assists clients with state and local tax matters, including audits, appeals, refund claims, and sales taxability analysis. You can see full bios for today's speakers in your audience console. In today's session, we will cover income and franchise tax considerations, sales and use tax considerations, and we will do a Q&A at the end if we have time. As a reminder, this is session 1 of a 3-part series focused on AI companies. Session 2 is on August 26th and will cover research and development and other tax incentives. Session 3 is on September 4th and will cover cybersecurity and SOX compliance. There's a link in your audience console to the registration page for the rest of the webinar series. With that, I will now hand it over to Matt Graham to begin the presentation.
Yeah, thank you so much for joining us. We got a great session here. So Just to make sure we cross all the T's and dot all the I's, we've got to make sure everybody gets that CPE credit. So we're going to jump into our first CPE credit question. Please make sure you answer that, and we'll make sure everybody gets their credit they need. Yeah, I'm not seeing any responses come through. Got a few. I realize we're kicking it off early. We got about 30%, 57%. A few more folks. All right. We'll close it here in 5, 4, 3, 2.5, 2, 1. All right. Good deal. We got most everyone in there. What is the favorite name? Yes, it's Tilly Moss. That was my pitch. But I do love where we're at though. So Big Tilly's great band to be under. So with that, let's jump into it. I'm going to hand things off to our first presenter today, Glenn Walsh, who's going to cover the income franchise tax pieces here. So Glenn, take it away.
Thanks, Matt. Appreciate people taking the time to talk to us today. One of the things that you're going to see kind of in an overview on what we're on this presentation, especially on the income and the sales tax, is that the AI technology is way ahead of where the tax law is. And so part of the discussions that we're going to have today is going to be around how do you take this developing technology that is not on all fours with the current tax law in many states, and how do you then apply that to be able to start making business decisions around what you have. And so just kind of a starting point, generally when we're looking at this from a sales tax perspective, probably going to be looking at AI considerations around, similar to services or other kind of licensing type of software technology type of application. So the general rules kind of breaking out are market-based sourcing, proportional cost of performance, and greater cost of performance. And then we do kind of want to highlight a little bit of what's going on in New York. And they've kind of seemed to have kind of thought this ahead a little bit and have put in some rules, sourcing rules that are more directed towards the AI space. And so if we just kind of move forward here, the one thing about market-based sourcing is the clear issue that we always deal with is where is that benefit going to be? And oftentimes the way the states are kind of applying this in many cases, they're kind of using a waterfall type of approach. Similar to what we do here in California is there's kind of different thresholds that you want to go through to be able to look at that. And so one thing that we do see in California, and I use California as an example, is that they really do want to go through as many books and records and contracts and other documentation before you get to census, to reasonable approximation. And this is often missed with taxpayers and tax advisors because they're saying, well, look, there's clearly nothing in the books and records. Let's go right to census information. I think we would probably say in AI, we'd want to put a pause on that. You really do want to look at the contracts and the books and records and see if there's anything in there that is going to show you where the benefit is. And one of the things that we're seeing is these are not standardized contracts. Obviously, they're learning aspects of it in some respects. So when you're looking at it, it's where's the real benefit? Is it the benefit you're doing work specifically for, say, the headquarters operation, and you can look to that. Oftentimes, this is being done for people that maybe are doing research and development type of services. And if you're looking at the books and records, oftentimes the states will say, well, books and records can be other than your financial statements and your financial records. You may want to look to, for example, where your employees are at. You have payroll records saying where those individuals are. So if that's the type of work that you're getting to, you're starting to look to where are the people that are actually using the AI, the type of technology that you're having. And so those are kind of the questions that are coming up. But when we're looking at this, you do want to dig into the contracts and the facts and understanding how this is actually being used so that you're able to have a framework and see what the support is behind it. I think,
Glenn, quick question on this one. I think, sorry, I'm so curious on this piece. I think, we see situations where like the market-based sourcing, it sounds like there's some possible variations in that. Is there situations where you could have like services attributable to more than one state, given the variation in rules? And like, is that legal?
Yeah, that's a good question, and the answer is yes, because the states are have different levels of technology and different tax law and guidance around this. And you can have the simple examples that we see right now, even is that you can look at greater cost of performance states versus market-based states, and how they're trying to say, well, for example, if you have AI in Virginia, and that's where the servers are, and that's where the development is, you could have a situation where greater cost of performance is sitting in Virginia. So Virginia would say, okay, we're going to source this to the state of Virginia, this revenue. But California might be saying, okay, where is this really being used? Where are those individuals that are using this located? And they may end up saying, well, those individuals are here in Silicon Valley, and they're working on it that way. So then California said, well, we think it should be coming here. And so that's where kind of that rub that you're raising, Matt, is that you can have a situation where you are actually have an apportionment percentage over 100%. You can also, glass half full as well. You can have situations where the reverse is that the servers and the people who are working on it are in California, and the people that are using it in Virginia. You could have a situation where you have nowhere sales as well. So it's important to kind of look at both sides on these types of transactions. Is where is it being used? Where the servers are, where the individuals that are using it, as well as maybe where the customer base is and where they are using it, so you understand both sides of that equation. The one thing that is a bit of a thought around this as well is many states have an exclusionary rule that says if you can't really identify where it's being used or where the service is located, you just exclude it entirely out of the apportionment factor. And so there may be states that are looking at this and saying, well, we really don't know where this technology is being used or who's using it, so we'll just take the position that it's not includable within our apportionment factor as well. So you want to be thoughtful about, it's not one size fits all amongst all the states. There's different nuances. There are different ways that people will look at that, and you do need to dive into the individual tax law. We were kind of, as we're talking about greater cost performance, some of the things that we would look at on a little bit of deeper dive here on greater cost performance is some of the questions that we ask is where are the servers actually located? Where's the processing power? Where are the employees, and what are the employees doing with the work that is being, who's actually doing the work? One other thing, and this is what we're seeing in the technology, is that there's often very small employee groups, but there's large independent contractors, both within the U.S. and oftentimes outside the U.S. So you do want to take into account when you're looking at costs for those states that allow you to include independent contractors, where are those individuals located? Because oftentimes what we're seeing is you may have that concentration of individuals outside the U.S. Oftentimes you see in Poland, you see in different areas that they kind of shift around. You want to be able to take those into account. So what you might find is, again, to the point that Matt was raising before, you may be able to get into a situation where you're able to allocate the revenue to a jurisdiction maybe outside the U.S. And again, reduce your apportion factor accordingly. So this kind of leads us into, that's kind of the starting off point, but oftentimes what happens with Nexus is that's the next piece. And with the ideal of kind of economic Nexus, kind of the overlay here is we often do want to start with the sourcing rules in this analysis, because the sourcing rules allow us to consider what, if anything, we have to be worried about on economic Nexus standards. So are we crossing over those economic Nexus standards in any states based on the sourcing rules, or how we determine those sourcing rules to be in play? And so that's one of the things that, as you see, is sometimes it's a little bit backwards from what oftentimes as professionals look at Nexus first and then look at sourcing. Because the economic sourcing rules, we often want to look to the sourcing rules before we get to the Nexus, because it's going to lead into that. The problem, if there, as I said, the problem here is that many states are going to lack clear guidance on where the sourcing is going to do, which kind of puts the taxpayer in a position where, are they going to be, how does that sourcing work to a particular state? And that they may want to be looking at analogous type of things. Is it really a service type of business, or the other things that we've talked about on this? One item that,
if I understand, one question on that is, like, if you so you could have a situation where maybe you have sales to a bunch of customers in a state, but if it's not market-based sourcing, then maybe you don't even have the Nexus. Is that kind of where you're going with that?
Correct. Is that if it's treated as if you don't have Nexus there and there's no cost performance, this is the greater cost performance rules come into play, or proportionate cost performance rules come in play, is if the sourcing is not going to I'm sorry, the economic sourcing rules, if you don't have any revenue sourced to the state, then you can have a situation where you don't cross over the economic sourcing rules. And so that's the situation that you're kind of looking at here is you can have a lot of sales into a particular state, but if they're not sourced to that state under the state tax laws, then they're not sourced there, which then brings in the considerations of economic Nexus not apply. And then you would just be looking to physical presence Nexus and where the servers are in the workforce. And if it's more of a remote workforce and you don't have people in the state, again, you may end up in a situation where you have activity in a state, but you don't have Nexus under the tax laws that are applied in that state. So one of the things that will come up in this area that we're thinking is really two things. One is really maybe companies are going to be looking for alternative apportionment methodologies, or petitioning the states to get there. Because when they look at their business, it's very difficult to kind of shoehorn the business into the current tax laws. And when they do, the application is not a good application for the company and their actual activities in the state. And so oftentimes we'll be looking to this and saying, should we be going to the state and asking for different apportionment methodologies, or providing ruling requests to them to get clarity around how the Nexus rules work, how the apportionment rules work, because they're not on all four with the businesses as they develop. These are things that I think that we're going to be hearing with our clients and guiding our clients. If it's material to them, these are good avenues to be able to get clarity for the business to kind of move on, which oftentimes state tax Nexus and sourcing rules, it's to get clarity so that you can conduct the business and understand the tax, either accumulation or tax losses or your taxable income in the appropriate states. So I kind of want to wrap up here in this section, and I think these are kind of, when we're looking at this, we really kind of this is how we kind of go through the analysis. And some of this is going to be, you'll look at it and say, well, this is obvious, but one of the things with the developing technology, we really do need to kind of dig into what is actually going on. What is the service? What is being done? How does the business view what they're being done? So you have a good handle on what the business looks like and where the property is located, where the employees, and how do they all work together. The other thing is that most people have a pretty good handle on the general rules, but because this is a these is new technology, and it doesn't necessarily settle well within the rules. You do want to kind of break open the books or look at and jump into the tax law here to make sure that you understand how can we take something that's a developing technology into tax laws that may not apply or not on all fours with what's going on. So it's going to be really trying to understand how those play. And you oftentimes will come back as what's really sometimes what's the intention? Do they intend to tax this, or how do they intend to tax it? The last two things is this is a developing set of rules. These are developing businesses. So when we're looking at clients, we do want to look at Nexus profiles every single year or periodically during the year. So we understand as the business develops, as the footprint develops, as the tax law develops, we're staying ahead of what potential taxes could arise. And the last piece on here is oftentimes when we're looking at these types of businesses, they're developing businesses. So there's net operating losses, there's research credits being accumulated. We kind of do want those against how do we accumulate them in the appropriate states. So when the business kind of either turns, and it may turn very quickly, that we have the attributes in the states available to the company to be able to offset the taxable income that's going to be apportioned. So those are kind of the basic nuts and bolts of when we're doing these types of analysis. This is what we're looking to.
Awesome. All right. Thank you, Glenn. So we got another polling question here. Where will you find the most important facts that will help with state income and franchise tax issues for your AI office? Contracts, invoices, marketing material, or all the above? Please get your selection submitted. And while you're doing that, just encourage everyone, if you have questions, please put those in the Q&A box. We're going to do what we can to make sure we answer those questions, either throughout the presentation or we may save them to the end if we think it's relevant. And then, yeah, we'll do our best. We did get one, Glenn, during your presentation. If you wouldn't mind taking this one. If you have an employee who lives in a different state and works from home, does that mean the company has economic nexus with that state? Would you mind commenting on that one, Glenn?
Yeah, they may not. And they may have physical presence nexus, but they may not have economic nexus. It's going to depend on what that individual does and how that contributes to the revenue, this stream. So if the individual is a developer that's developing products and developing the applications, that activity may be sufficient for the state to say you're creating a market in that state. So therefore their activity in that state creates physical presence. But from an economic standpoint, really right now what people are looking at from a market-based sourcing is where the customers are, but probably more specifically, where are the users of the product located? And so an individual that's physically present in the state may create physical presence nexus depending on what they're doing. But that's likely they would not create economic nexus because there may or may not be revenue directly related to that individual.
Awesome. All right, we got 86% of votes in here, and I think we're going to call it in 3, 2, 1. All right, we're wrapping it up there. All of the above. It's great. Contracts are awesome. Invoices are good. Marketing materials also good. Maybe not as good as some of the others sometimes, but all of the above. We try to look at all of it, and there's a lot of good intel on the different angles there. All right, with that, thank you, Glenn. And now we are going to move into credits and incentives with Senator Evan Krueger here. So, Evan, take it away.
Yeah. Thanks, Matt. Let's see. So really, with credits, there's quite a few aspects that can really affect really any growing business, and whether that's growing, organically, it's growing through acquisitions, or it's just an expansion project. There can be a lot of different facets to that project that can, affect whether you might want to locate, say in state A versus state B. And just a few of those here on this slide. So obviously, real estate, availability and prices, proximity to the things that might matter to you, utilities, as far as power and water, especially within the context of a data center, workforce, as well as obviously tax implications. How does that then translate to your bottom line? And are there programs out there that can help offset your costs and make either the initial investment or your ongoing operations a little bit more palatable?
Evan, of the stuff we've got on the screen here, what's the hot commodity these days? What are people most kind of interested in, or what do you see the most of?
Recently, and it's a good question, and recently, especially as different companies are starting to invest more in data centers in particular, something that's come up a handful of times now, especially on the utility side, is just the availability of the power. We've gone to different utilities or different municipalities and said, client wants to move forward with this project, and the utility just doesn't have capacity, and they say, well, that's great, but we have a queue of projects, so you're number 4 or 5 in the list, which isn't incredibly helpful if you're wanting to move quickly and wanting to move now. And then the other is actually workforce. A good example recently, we had a client. Admittedly, it was a little bit of a pie in the sky kind of idea. They wanted to relocate their headquarters out of California, and they wanted to go somewhere that was ideally close to like a national park or something of that sort, just out in nature, away from the city, which again was a great idea. But then when we kind of run the analysis, and it comes back with that they're going to have an incredibly difficult time hiring the technically skilled people that they need for their company and for their project, it was just a no-go. So sometimes really just availability and cost of workforce can really move the needle on whether a project moves forward at all. And then if it does, if you locate in state A versus state B. And then obviously probably the third, if there was a third, would be, everyone wants to talk about, if I'm expanding my business, what can I get out of the state? What can I get out of the county, right? How can I make this project more palatable, and more, financially just make sense? So there's a lot of different tools in the toolboxes of the states and of the local economic development organizations that are out there. This list is really just a few. It's certainly not expansive or complete by any means. The items here that are highlighted in green are the kinds of programs that tend to be the most common out there. They're programs that a lot of different jurisdictions have. So yeah, you will see a lot of energy efficiency credits or grants, or just generally credits for investing in renewable property. Lots of hiring credits, payroll credits, sales tax exemptions or special like refund programs, things of that sort. Those are all pretty prolific, out in this space. But with a lot of these programs, they're discretionary. You have to go forward to the state and negotiate for it and ask. There are things that they can offer. There's lots of things they can do, but they don't necessarily openly advertise all of those things. So kind of with that in mind, for our AI developers out there, what's applicable? What's kind of the thing that's going to move the needle most for you? And really, at least at the state level, the biggest offering that they have is job creation and hiring credits. So when you're adding headcount, when you're opening a new office, if you're like my kind of pie in the sky client example, relocating a corporate headquarters, just maybe not to Jackson, Wyoming. There's different programs out there that can incentivize you to relocate to one jurisdiction over another, and they can take a lot of different forms. They can be an income tax credit. Sometimes it's takes the form of a rebate, and sometimes that's based on a new wage paid or based on new taxes that you pay in as the employer. A lot of these programs, again, discretionary, and they're post-performance. So meaning you would negotiate it with the state, you get an agreement, and then the agreement would say, the state's going to give you X amount of tax credit, but before you earn it, you have to hire, 50 new employees, and you're going to pay them all a minimum wage of, $100,000, just for sake of example. Well, then you need to file compliance and certification with the state to say, hey, I held up my end of that contract, so now I have earned my tax credit, and they certify that, and then you earn your credit. So they're not just handing the credits out for free.
That's 100. I feel like some of the, they 100K is decent wage a lot of the time, but I feel like I've heard in the news here lately, there's like people making, like $150 million on like a signing bonus for some of these AI companies, which obviously, clearly, we're in the wrong business. But how does that work with these incentives? Like, is there like a percentage? Because I would imagine, like, if it's like 6% of wages to pay to this person, that's a lot of money in terms of tax incentive. Is there like a cap on these things?
Also, good question. Some of these programs, they'll be structured as like a flat credit amount, so that you say, $5,000 of credit per employee or something of that nature. So at least in those contexts, that doesn't necessarily come into play. Generating a 6% credit on $100 million comp package would be quite a lot. But in the context of even programs that are based on like percentage of wage or percentage of new tax paid, it would really depend most of the time on if if the program's benefit is paid to you as an income tax credit or if it's a rebate. Because obviously in the context of if it's like a corporate income tax credit, your ability to use that credit is probably more naturally limited by your tax liability, if you have any. So that's probably something that would end up having to be carried forward for a number of years, versus if it's something that's a cash rebate that the state is going to pay to you. That's probably where it's more likely that they might cap it out and not pay that full amount to you. And since they're having to cut that check currently, as opposed to maybe it's something that more naturally just gets deferred, and they kind of kick that can down the road. And equally, sometimes it just depends on the rules for the credit, or if the state kind of makes a change. A good example recently is in California. They had adjusted the rules on how you utilize your credits or how you utilize your net operating losses. That really restricted how much you could use them, just to kind of help balance their budget. So sometimes it's just there can be just a current year law change because the state needs to balance their budget one way or another. Maybe the state's doing really great and they make it easier to claim credits. So really, it's everyone's favorite tax answer of it depends. And obviously, if you're a developer, probably the other biggest opportunity outside of hiring credits is your R&D tax credit, just research and development. I'm certainly not an expert in the R&D credit by any means, but our colleagues who are experts on the R&D credit, that's all session 2 coming up in August 26th. So for anyone who's out there listening and you're really hoping to hear about R&D, stay tuned, come back in, a couple weeks or so, and you'll hear all about it from people who are far more qualified than me to speak about that. So we've talked a little bit about AI developers and people who are actually working on those models themselves. But for that backbone, for that infrastructure in the data centers, what is out there? What matters for you? And really, this takes maybe 2 different flavors for the most part. The first is sales tax. A lot of states, about 19 or so, offer some form of sales tax exemption or refund or something similar for equipment that's purchased, installed, and deployed for use in a data center. So that can be anything from the servers to racking. It might include other pieces of the property that are kind of important for functioning, as far as the data center goes. So stuff like your cooling and things of that nature could extend that far, just depends. And then similarly, property tax. So certain states and obviously, because property tax is administered through the counties and cities, states are partnering kind of with their local government partners there to offer different property tax exemption programs. These could be, an exemption or an abatement, or maybe it's a rebate, kind of takes all different flavors. But for any equipment that's purchased and installed in the data center as well, that can also get some property tax benefits too. One thing that's important to note, and I'll walk through a practical example here in a minute, but for both the sales tax and property tax programs throughout the states, most require some amount of minimum investment, or maybe there's hiring or sometimes some other requirements. So it's important to kind of keep those things in mind and make sure that that state's requirements align with what you are planning to do. You don't want to let the tax tail wag the dog, so to speak. You don't want to just go chase an incentive that ultimately does not align with your business, with your plans and your goals. So as promised, a quick little practical example of a sales tax program in Minnesota. And one thing that I'll draw your attention to here is it's got quite a few requirements on the second bullet and the following sub bullets. So it requires at least 25,000 square feet for the actual footprint of the data center itself. And then they're wanting you to have 30 million of capital investment in that facility. And that has to be within a 4-year period. And then the one kind of interesting requirement that this program has is the requirement essentially for redundancies and backups. And that's definitely a unique feature and something that not all states have, but it just goes to show that different states, they may want to see different things from you to offer you the incentive. And Minnesota is also an interesting case in that it's not a straight up exemption that you would take on purchases in real time as you place things in service. It's a post placing in service refund that you file with the state. So you supply all your documentation, apply to the state for the sales tax refund, and then they review and certify, and then they pay it out at that point. So there's a little bit of a cash flow or present value kind of calculation you have to think through first if that's something that's going to be really material for you. And then just another quick example of a property tax program. Excuse me. So Hillsborough in Oregon, they've got an enterprise zone, and they can offer a 3 to 5 year property tax exemption. And then again, similar to the Minnesota program, it's got quite a few requirements and components to it. So minimum investment of $1 million. And their kind of interesting requirement here is you need to demonstrate that a certain amount of your purchases will be made from locally based companies, also in Hillsborough. And then last but certainly not least, manufacturers, what's out there, for folks where maybe you're using AI as part of your process. So the quick hits version is a lot of those same opportunities that we've already talked about. So hiring, sales tax, property tax, those can all be applicable to you. But one thing to keep in mind here is there can be certain opportunities to receive credits for retaining employees. And what we mean by that is if you're automating and streamlining your production, say you're putting in a bunch of new machinery, there can be a play to say, these are people that would be displaced because you don't need as many people, actively on the manufacturing floor, but you're going to retain them and retrain them to then take more of a overall supervisory and maintenance role, since obviously somebody still needs to be around to maintain all those machines. So just to keep in mind that, credits plays aren't always just limited to, when you're expanding or acquiring or growing. There can be other avenues too. So with that, what types of credits or incentives are most interesting to you? Data centers, employment opportunities, different energy opportunities, or perhaps something else?
All right, folks, let's get those submissions in, and we can keep this train rolling. We got a couple questions in the chat here. I had a question about Michigan localities. That may be something we want to follow up with you on after the call. There's probably more detail to go into that than we may have time for here. And then we had another note about Hillsborough. Yeah, certainly. We'll try to address that at the end if we have time. Get those responses in there. Maybe the data center one. I feel like I hear about that a lot. All the data centers are being built these days. All right, guys. 5, 4, 3, 2, 1. All right. Wow, look at that. Pretty, not an even spread, but a better spread than I would have expected.
Pretty mixed bag.
Yeah. Interesting. So looking at employment as the winner, though. Everybody's excited about trying to figure out how to get credit on those big incentive packages. So awesome. All right, guys. Well, yeah, thank you, Evan, so much. Great coverage there. I'm going to jump into my section here. Sales and use test considerations for AI. So I'm just going to kick this off with kind of what do we know, what do we not know? What do we know? So AI industry is obviously creating a bunch of shakeup, right? There's a handful of different things going on in sales test world related to that. However, I don't want to give you the illusion that like everything's really complicated, because not all of it's complicated. But the hardware side of things, like our data centers still subject to tax in the same way they largely were before, at least in terms of like infrastructure services or whatnot. A lot of that stuff isn't really going to change, and the infrastructure services that you might use to support AI, like if you're running your AI products on Azure or AWS, the fact that you're running AI on it isn't going to change the fact that it is just taxable like it was before. So there's a lot of stuff like that is not necessarily weird or gray or complicated. Where the weird, gray, complicated stuff is going to come up is going to be whether or not certain AI services or tools that are accessible or delivered via the internet, whether those are subject to sales tax when sold by those vendors. I think that is really going to be what I'm going to hammer on here and hit on. That's kind of where the rubber is going to meet the road in terms of complexity. Just want to make sure I highlighted that piece of it. Okay, so I want to jump into some general rules here. Taking a big step back in terms of the sales tax base. Every state generally that has a sales tax is going to impose sales tax on tangible personal property and certain enumerated services, meaning that not every service is taxable, but some services are taxable. And those services usually have a defined category and a definition as to what that service is and what makes it taxable. And generally, when you're looking at some of these AI tools and services, they're going to slot into one of these categories I've got up here on the screen, like software, data processing services, information services, and there's some other categories here to think about. With regard to software, when we're looking at software, we're usually, if we're going to put something into that software category, you're usually looking at something that has like a software license granted, or the customer has some sort of degree of control or functionality over the product in order for it to be considered a sale of software. Data processing is a little bit different. Data processing is it's historically understood to be providing data to a vendor. The vendor is going to do some operations on that data and provide it back to them to extract something or convert information into usable data. However, there's a handful of states out there, I'm looking at you, Texas, maybe Ohio, DC, and Connecticut too, where they have a data processing classification, but they interpret it very, very, very broadly to include a vast majority of services delivered online or electronically. Information services, you can kind of think of this as, you're buying a service that gives you access to information. That usually takes the form of like a subscription service to a database or a list or lead generation information, stuff like that. There's just kind of a handful of different ways in which information services can show up. And then it's kind of, this little last catch-all here. There's some other categories in states that are very unique, like Washington, my home state here. We have digital automated services, which is defined as any service delivered electronically using one or more software applications. Well, that's just going to be anything that happens over the internet for the most part. There are some exceptions to that, but it's a very broad definition. And so usually we're going down this list and trying to figure out, does the AI product or service that you sell, does it fall into any one of these categories or even maybe more than one? But that's it. Usually kind of we give you the flavors here. It's kind of the starting point of the analysis a lot of the time. Okay, so jumping into kind of overlaps here. So this slide's really important because you can have an AI product or service where it has elements of these different things I'm talking about here. So you may have, let's just throw out an example here. Let's say we're talking about an HVAC company wants to get an agentic AI customer service agent, but you have to have that customer service agent up to speed on maybe the products or the services or the industry standards related to these HVAC issues. So maybe you load that AI up with a bunch of industry knowledge, maybe some of it's public, maybe some of it's not public, what have you. But when you sell that AI product, what is it? It may be construed as an information service in some states because you've loaded it up with so much information that it can functionally act as like a reference kind of search engine within that database that you give it. It may also be considered software because it has some software aspects to it. You are controlling it and having it help you deliver customer service support to your customers. And some states, like I mentioned, they call that data processing based on their very broad definitions. And other states like Washington Metro call that digital automated services. So you can have some of these AI products out there that span more than one category. And that kind of brings us to that first bullet I have here is sometimes when you have a product or a service that maybe has some different subcomponents to it, that could be treated as a bundled transaction in some states. So they might say, yeah, well, we don't tax SaaS, but we do tax information services. That's the example I have here from New Jersey. And, this HVAC agentic AI example I'm giving you here, maybe New Jersey would say, well, yeah, it's not taxable, it's software as a service because we don't tax that. But it's got enough information in there that we think at least some component of it is taxable as an information service. And if that's the case, you could end up paying tax in New Jersey on those grounds. So I think this is going to go back to some of Glenn's earlier comments is you do have to kind of look at what does this thing do? What do you get? And what kind of information comes out of it? What's the value provided? That's going to help you determine which category does it fall into, or does it fall into more than one category? And how does this manifest in other states? In some states we don't even necessarily have to specifically fall into one of these categories. I think Arizona is one of my favorite examples on this. Is that they'll say, well, we tax tangible personal property, and tangible personal property is anything that can be perceived by the senses. Like, okay, well, that's cute. You can, just about any AI product, if it's doing anything of value, it's probably perceivable by the senses to some degree. So there's going to be some odd outcomes through this. But I wanted to highlight this, that you can have a situation where maybe any one of these categories could tip a transaction into being taxable in full. So thinking about this, we've got, figure out how to solve this puzzle, right? Because we have little to no published guidance from the states. at this point, we don't have letter ruling, we don't have case law, we don't have administrative guidance that says, well, we're going to tax AI products like this, or these are the types of AI services that may be taxable as information services. So the practical approach here is really getting down to reviewing the information available, which is usually looking at the contract, looking at the way the product or service is described, looking at what the customer can actually do. I'm a big fan of actually having someone give me a demo and show me everything I can do with this and how I can interact with it, how much control I have over it. That's going to help drive how we analyze these issues. There's the questions that I usually ask. Is this more of an AI-enhanced legacy service? Meaning, like, are we talking about AI that's used to deliver a service versus AI is the service? I think that's a question that is probably maybe the most important question here. And maybe I'll give you an example. So imagine you've got a legacy kind of recruiting service, headhunting. So, historically that might look something like, you're going out there, you're interviewing people, you're finding candidates, you're screening them, and then you're presenting those to your customer to, review as possible candidates for a job. And that can, if you were to take certain aspects of that, like say you took the first couple steps of that and you said, well, we're going to have an AI agent screen resumes, do the initial interviews, and then we'll kind of hand it off to a person to do a final interview and then present it to our customer. Okay, well, is that an AI service, or is that a professional service that's kind of enhanced with AI? And it's a good question, but a lot of times it's going to depend on a variety of factors, like, what is the contract saying? Are we granting the customer a license as part of the AI? Does the customer actually even see the AI or interact with the AI, or is it something that the recruiting company is going to use in their process? So there's stuff like that. Again, I think that's probably one of the more important questions to ask here. Does the AI offering have a large data set of publicly available information it draws from that could pull you into information services? Is it interacting with humans, or is it more automated? Like, there's things that are purely automated that just look at issues in the background between servers. So there's a variety of different things that could come up. I'm going to skip the last couple of hints. We're running low on time. Wanted to comment on just a couple of things within industries. You see AI as kind of a component of different service offerings to different industries. One example I think that I've seen is there's some AI products that enhance manufacturing processes that maybe make things more efficient in terms of energy usage or workflow. And, a lot of the manufacturing incentives out there will say something like tangible personal property used in manufacturing is exempt from sales tax for manufacturers. Well, AI services are not necessarily tangible personal property, but sometimes software is defined into tangible personal property. And so if you were servicing the manufacturing industry and you wanted your manufacturing customers to be able to claim a sales tax exemption on your product, you may consider structuring it as a software sale to get it into the definition of TPP so that they can purchase it sales tax exempt. So kind of maybe the takeaway here is to think about how, what are the exemptions and incentives that your customers have that they may be entitled to, and how does that align with what you're selling? And is there a way to align what you're selling so that you can help your customers claim exemptions in those types of situations? I think that's something we're working with clients on, and it's a helpful way to kind of make your product more the cost of it maybe more palatable. It's just a little bit cheaper when there's no sales tax on it. So main takeaways here, the major risk is not oversimplifying the approach. A lot of people say, well, we think our AI product is SaaS, and so we're going to just treat it as SaaS across all these different states. Well, that could get risky if you're just going to blanket categorize it into software as a service. For kind of going back to my New Jersey example earlier, if it is also kind of thought of as an information service, and you're selling in New Jersey that doesn't tax us, but they do tax excavation services, you may have an issue. You may be not collecting tax when you should be. And so just be careful not to oversimplify it. States are revenue hungry. They're going to find anything that they can hang their hat on to call it taxable. And so just don't oversimplify it. And if you get it wrong, the penalties can be pretty steep. You're talking about having to pay the tax out of pocket plus interest plus penalties, which can rack up pretty quick. And that's never good, especially for a growing AI company. Maybe you're early stage, you're trying to get into your next funding round, and your next investor is asking, well, it looks like you have a pretty big sales tax liability out there, and that's going to impact your valuation or may result in a holdback or something like that. So it's important not to get this wrong. Sales and use tax is a hot topic, both within the M&A space and just also states are enforcing this stuff with an iron fist these days. And then kind of just this last piece here, customer satisfaction. If you can figure out how to structure your sale or your offering in a way that's going to help them qualify that for a sales tax exemption or some of the incentives that Evan was talking about, or even get you to a place where you may have a more favorable outcome for income tax sourcing, like what Glenn was talking about. There's ways to plan for this, and it's going to take a little bit of a careful touch to craft these things in a way to get to the answer you're targeting. So with that, I'm going to jump into our last polling question here. Are all AI products or services, are AI products or services should be taxed as SaaS? True or false? A little typo there in that one. Apologies. So we'll try to get some of these responses here. It's the last question, guys. Got to make sure you get that sweet 1 hour of CPE credit. Don't want anybody to miss out on it. For those of you who are refilling your coffee at the last minute, run back to the computer and click true or false. Give folks a couple more minutes here. We got a couple more questions we may try to address here. I'll just give everybody just a minute more. Oh, can't see the question. Garrett, we may need to tackle that from a different angle, or we may be able to try to use your Q&A question as a record of attendance. We'll see if we can make that work. I think the poll appears to be appearing for almost everyone else. Oh, great. Okay, awesome. Got that taken care of. All right, guys. Closing it up in 5, 4, 3, 2, 1. All right. All right. Don't split there. Yeah, no, we don't want to try to overly simplify the approach here. Not everything's going to be subject to sales and use tax. There's a lot of states that do not tax any kind of digital products or services. You can think of it as, maybe 20 to 35 states are going to be pretty high risk for possibly taxing something. There's about 10 states that are very low risk because they just generally don't tax anything that's not delivered in tangible form. So there's we tend to know where those risks pop up. The two that I think I see probably the absolute most often would be Washington and Texas. Those two are fairly aggressive in taxing just about any and all digital products and services delivered over the internet. So with that, we'll wrap it up here. I think, apologies, we weren't able to get to some of these last questions we had here, but thank you for your time. And I hand it back to Josh here for just some final wrap-up comments.
Thanks to Glenn and Evan as well for a great presentation today. Just as a reminder, if we didn't have time to answer your questions, we will do our best to follow up with you after the webcast via email. If you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast webcast console open for a few minutes to give you time to download your CPE certificate. A copy of your CPE certificate will be emailed within 3 weeks should you have any difficulty downloading it now. And here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us. We hope to see you at the next session of this series where we'll be discussing R&D tax credit opportunities and federal incentives for AI development. This will take place on August 26th at 10 a.m. Pacific time. Thank you.